Welcome. I'm Josh Landau, the president of the International Insurance Society. I'm excited to introduce our next webinar. One of our key global partners, Reinsurance Group of America Incorporated, will discuss the technology transformation of consumer and distribution expectations and its impact on the way insurers will underwrite. Nic Lempriere-Hogg, Senior Vice President and Head of Global Underwriting Solutions for RGA, will moderate the session and share an overview of the development and acceleration of the current environment and its implications. Nic has more than 35 years of broad technical management and leadership experience in the life insurance and reinsurance industries. He's been with RGA for 24 years, and in his current role, he oversees and supports underwriting across RGA's businesses, as well as the development of RGA's underwriting philosophy and strategy. Nic's team is responsible for the production of RGA's highly successful global underwriting manual. Welcome, Nic.
Thank you, Josh, and thank you to the IAS for partnering with RGA on this webinar. As Josh mentioned, I've been in the insurance industry for more than 30 years, and I can't think of another time in my career when there's been as much innovation and change occurring in the underwriting process as there is now, and the pace is only going to increase in the coming years. Technology has really set the scene for innovation in our industry. But it's taken the pandemic to cause a seismic shift in the consumer behaviors across all generations, such that the digital consumer is no longer characterized by a specific age segment in the population. It's all of us. In our webinar topic today, Underwriting for the Next Generation of Consumers, we'll be discussing the implications of this to the insurance industry's distribution and underwriting approaches. Exploring these concepts today are three of our leading subject matter experts, and it's my pleasure to introduce them to you. Peter Rhodes is Vice President, Consumer Engagement for RGAX, the transformation engine of RGA Reinsurance Company. Based out of Chicago, Peter is a member of RGAX's innovation team with a global role in developing novel and disruptive approaches to engaging with life and health insurance consumers to enable them to live healthier, longer, and more financially secure lives. Next up will be Scott Grandmont, who is our Vice President, Business Initiatives Lead, also for RGAX. Scott is based out of Connecticut and is responsible for underwriting innovation that focuses on developing products and capabilities for a range of carriers and partners. And our final speaker will be Paul Okeefe. Paul is Vice President, Global Business Development for Aura Technologies, and is responsible for worldwide sales and account management for the Aura product suite. Based out of Toronto, Paul works with RGA global and regional business development teams to assist RGA's customers in implementing e-underwriting solutions. And to kick things off, I am going to turn it over to Peter, who will discuss the ongoing merging of consumer and channel experiences, driven not just by the pandemic, but also by new entrants looking to disrupt. Welcome, Peter.
Thanks, Nic, for that introduction. I'm excited to be here today to set the table for our conversation today, and I'm going to start with some trends on the new consumer. So what does this next generation consumer look like? First, I'm going to talk about demographic changes. Really what we've seen, there's been a slowdown in birth rates, there's been a delay in family beginnings. All of those have kind of had a muted effect on some of the market growth rates. But what I call out here on the right is something that's interesting of three online leaders in the direct-to-consumer space selling life policies, Ethos, Bestow, and Ladder. And what you can see is their demographic profile of sales that they've made over a 4-month period of time. What I think you'll notice is consistent across all three, both the blue and the orange spikes are the millennials, and those are the highest online purchasers today of insurance, not surprisingly. The other thing, though, that is an interesting little twist, if you look at the Ethos line here, Coverager points out where this was sourced from, that Ethos was activating offline agents, and so they were seeing an increase in sales in that older demographic compared to the other two. But I think this is a good foundation setting for who's online, what's the demographic profile of those that are currently buying. And then the next point, the millennials are going to dominate of all the generations. They're going to make up 40% of the US population in just 8 years. So the force to be reckoned with is coming. However, one of the interesting things about the millennial population, if you think about it, 52% of the wealth is controlled by the baby boomers. while only 5% of that wealth is controlled by the millennials. As that wealth transfer and wealth accumulation continues, the protection needs for the millennials will increase even more. So I think you're going to see this trend accelerate. The third trend is just this acceleration digital transformation. COVID has been a tremendous tailwind to online activity. When things were stopped, and really even today, there's still at times limited face-to-face interaction. Everything's happening in a digital format. The distribution community has kind of reached out. You're seeing some increase in online activity. I've been trying to help quantify that. One of the quotes I've seen, they claim that we've seen 5 years of acceleration in just the past 12 months. So it's really been a condensed, accelerated time for digital transformation. We've seen it in the startup community. We've seen it in carriers. And then the last thing to highlight, I think, is the new consumer attitudes. What's really important is this notion of trust. Can people trust the online buying experience, trust the brands that they're interacting with? The use of personal data is really important. The new millennial wants to be in charge. So this permission-based economy to the personal data, really important. And then there's a trend to social and purpose-based commerce. You'll see that a lot in the ability to give back. And then, I'd have to underscore this notion of the rising expectations. We know what Apple and other, Facebook and others are doing to raise the overall expectation in terms of a seamless experience. But I like this quote from Wonderman, an online digital marketing agency. They're looking across all retail industries, and the way they sum it up is they say, what consumers crave is an innovative and omni-channel shopping experience. And I really think that's what we're on the cusp of. How do we create that in today's new environment? So I want to drill down just a little bit on digital and go a little bit deeper into the trend there. So with the backdrop of COVID, what we've seen is a steady interest in the category of life insurance sales. So it's interesting. I would have expected it to perhaps increase more than it has, but it's remained steady, which is positive. It's really helped kind of level off sales. They've no longer been in a slow decline. So that's been the good news. As you're all aware, we've crossed the threshold of 5 million deaths globally, and it's still with us. So it's still an issue that we're all dealing with, and it's allowed the level of interest to remain steady. One of the other kind of trends that's coming up is this rise of embedded insurance. This is one that I think is really key. This is where you're beginning to see new experiences bundled together, where you're getting product and process pulled together. So leading consumer brands are looking to capitalize on really timing and relevancy to provide insurance offers. So, one example could be the mortgage industry. We've seen where the purchase of a mortgage or refinance of a mortgage is a logical time, life event that would lend itself to life insurance. And so we're seeing companies like Intuit, Rocket Mortgage, and others wanting to offer simplified issue policies during that process. And it's really a desire for an apply and buy. And if you think about that, that has tremendous implications on the underwriting future. And Scott will talk a little bit about that. The other one where I've seen a lot of this embedded insurance take off is in the property and casualty space. And I want to offer up one of my favorite prognosticators there is Elon Musk. And in the P&C world, this is the way he thinks about it. He says, insurance is a good example of a product that's made by our internal applications team. We make the insurance product and connect it to the car. We look at the data, we calculate the risk. This is all done internally. Basically, it's an internal software application. So, I think it's an incredible example of how they're collecting the telematic data, using it for underwriting purposes and blending it into their overall offering. He goes on to say that he thinks about 30 to 40% of the value of their company could be related to insurance in the future. It's pretty staggering. But I do have one cautionary note here on this slide, and that is convenience doesn't sell insurance. Just because we make the offer doesn't mean that we complete the sale. And so it's really that challenge, that embedded or even a standalone, you've got to make it personalized and relevant and timely. If you just look at the bottom of the chart here in red, you can see this is one online seller's conversion rate for 4 months. And you can see it's relatively steady around 3%. That's a pretty low yield when you compare that to an agent-based or a true selling. So just offering doesn't make our product fly off the shelf. So you've got to create this better experience. And here's the important part, that what does that better experience consist of? Well, part of it is the product for sure. And in this case, these products, this is a simplified term offering, so pretty easy to understand, and yet you still have some of these conversion rates. But it's going to be about process, and Scott's going to talk a bit about that. And you also need to include emotion and engagement. I think it's the proper blend of all four of these things that will really help us capture that next generation consumer. So as I kind of wrap up, just two questions I'd like to have you keep in the back of your mind as you listen to my colleagues. One is, what is my target market? Of what I've shared with you, what are they wanting? What do they need? And how do I focus on them? And then what blended experience can I create that's going to really drive sales or create differentiation? So thank you. With that, I'm going to turn it over to Scott to talk a little bit about some of the underwriting implications and process.
Thank you, Peter. Appreciate the introduction. Bring me to the next slide, please. So Peter set the table nicely for our continued discussion around how underwriting is dovetailing with this next generation consumer. And importantly, some of the additional dimensions of this that give us a great future to build together, but also an array of challenges that'll need to be addressed. I like to think of underwriting as the road that we travel together. That's historically been the way I framed it. After 3 decades in the industry, that remains the same in my way of thinking. And I think about it that way because of the fact that underwriting serves both market, as Peter was talking about, as well as the product itself. It has to work together. They have to work in harmony. And this next generation of customer, as well as the unique ways that we're reaching out to customers and getting in touch with them and offering them protections, perhaps in embedded solutions, is really challenging how we compose those market solutions. All of us have to run to kind of keep up on that front. So with those rising expectations, clearly there's wonderful opportunity. There will be new tools, new processes to be brought to bear. But importantly, there'll be challenges that will need to be addressed. These solutions don't simply bolt into the existing process. It's important to know that we're not dealing with the digital equivalent of traditional evidence. We're dealing with whole new things. And as a consequence of that, we have to kind of keep this idea of the market solution in mind. It always has to remain in harmony. If we create a new tool, capability, or experience, we've got to make sure that we understand the impacts across that market, the customer journey, the implications from a pricing and actuarial perspective, and importantly, making sure that those tools and capabilities enable the underwriting function to deliver on the promise, which is making sure that the other two dimensions work. So carriers and producers and new customers are all meeting in this crossroads, and we're all really hustling to make sure that we can keep our products in front of consumers, be it traditional consumers or new consumers, and effectively making sure that the products that are offered drive durable value for everybody in the equation. One of the things that I think is a wonderful silver lining of the confluence of technology and data and the new customer is the potential for tailored solutions. I would describe tailored solutions are those that really kind of try to find the greatest, most effective way of optimizing, getting in front of a customer, providing them with the right kind of product and the right kind of experience that allows them to understand the product, see that there's durable value before them, and importantly, move forward very quickly with the acquisition of that product, almost like a checkout process. In years past, we've oftentimes composed product and process with the broad market in mind. This new paradigm creates wonderful opportunities for everybody involved. So what are we working on today? In essence, the game is changing to be sure, but the goal remains the same. The basic function of underwriting, as I alluded to a few minutes ago, is to deliver on the mortality or morbidity expectations, but we'll be doing so in new ways. Today, the industry is awash with opportunity as it relates to data providers, scoring providers, technology platforms, new distribution partners, all of which are meeting in this crossroads. And we, as business leaders, have to compose workable market solutions. Not all of the things that show up into that marketplace are relevant for the specific product that we have in mind, or the distribution or customer that we have in mind. We have to think through the application of these new tools with that market solution in mind, keeping in mind that the availability of data, the utility of these new data sets, and perhaps even the defensibility of them vary substantially compared to what we've known for decades at this point. The framing I'll give on that front is simply the traditional evidence. We've known and loved that over decades. We understand what it does to support the underwriting and actuarial function. We also know what it can and cannot do relative to experience. So with these new tools in mind, your chief underwriters, your chief product actuaries sitting across the table from a chief marketing officer are making decisions in a market solution with new tools and capabilities, and really creating new potential for us to reach out to those customers. Keep in mind, with all the newness at play here, there is time and effort that is required to inform decisions on this front. Unlike traditional evidence, as I defined before, which we've known for decades and understand exceedingly well across a number of dimensions in the marketplace, we've got new tools that don't perform like the old ones do. They perform in new and interesting ways. And certainly the most beneficial aspect of that is many of these are available real time, creating great actionable point of sale experiences, really valuable for our distribution partners and our customers alike. With that being said, we are making decisions that don't have a long history of credible experience to evaluate and understand implications. We've got almost no experience with these. We do retrospective studies to surmise what we might be able to derive out of these new tools. But what this has created is a bit of new urgency relative to evaluating and monitoring these tools in market and making sure that they're performing well against the expectation, and basically synthesizing what we've experienced over time in terms of credible evidence. So as you sit across the table from your chief underwriter or chief product actuary, understand some of the complexities at play in simply looking at a new data partner and understanding whether or not it could be beneficial beyond experience itself. Does it derive the value that we need in terms of replacing protective value that might be lost if we sidestep traditional evidence? Also, do we know whether or not that very same tool is provided to us in a manner that is easily consumable by your underwriting department or the technologies that help to support point of sale experiences? With this, one of the great silver linings of the direction we're all going is this possibility of more granular insights. We're dealing with technology that allows us to see very detailed information at a very granular level relative to the mortality and morbidity of our customers, and importantly, surmise what is going on at top of funnel as we compose approaches to market, which yields an applicant pool that is either the same or different from our traditional applicant pools. And in terms of underwriting, how our tools are performing against that applicant pool. Are we serving the needs of that market solution in a way that is durable and creates advantage for all three of the stakeholders? And as I shift my view to the future, I think about the challenges as well as the potential to unlock a really interesting capability for us going forward. And I think there is certainly more value than there are challenges, but the challenges do need to be addressed in a fairly comprehensive and to a degree coordinated fashion. If I think about the value of what we've got, again, these are new data products that in many circumstances provide tremendous protective value, and it's also available real time. As an industry, we are still trying to figure out how best to assimilate that and how best to automate the analysis and consumption of that from a risk selection perspective so that we can truly live up to that point of sale decision experience with these new tools. It's going to be a bit of a journey. A lot of these tools are available real time, but the work product comes back to us in a fashion that requires us to think carefully about how we tease out detail relative to that. This new landscape also gives us the opportunity to think about dynamic determination of requirements for the very first time, as opposed to scheduled evidence, where at a given face amount or a given age, you get a given array of requirements. In this new paradigm, with the right level of insights and the right tools composing a market solution, we could very readily be much more efficient relative to the selection and use of evidence, again, supporting the types of experiences that the next generation consumer is looking for. And with that flexibility, perhaps one of the complexities is that we've got a fairly heterogeneous landscape emerging. And what I mean by that is if everybody's following essentially the old scheduled evidence, you had a very homogeneous landscape. Now in this new paradigm, each carrier is going to be curating their own data, their own approaches to using that data, and how they're going to optimize the ability to serve the needs of the customer. That's going to be a very interesting, very complicated landscape, but one that could unlock competitive advantage for carriers and ultimately serve the needs of the customers that they're trying to pull into their applicant pools. With that, evidence optimization and process optimization will go hand in hand in the future, and that is a really good thing. Relative to the challenges, I think we're embarking upon a period of time where going it alone is going to be a little bit more difficult. Here's my call for a little bit more cohesive approach to problem solving in the industry. We need to be leaning into this problem of compound complexity. Think about how we arrive at a common language or a common data dictionary, so that we don't have a situation arising in 5 or 10 years where there is just a number of dialects emerging relative to the consumption and scoring of data. It's a challenge, to be sure, but one that I think the industry is ripe to solve together. And with that, I'd like to tee up the next phase of our presentation, which is thinking about how we enable these new capabilities and dovetail with that marketplace that Peter set the stage for. I'd like to bring Paul Okeefe into the conversation at this point to talk about digital enablement.
Thank you, Scott. I'm going to talk about automated underwriting decision systems and the really rapid change that's undergone in the last several years that I've been involved in this. You heard from Peter that there's only been 5 years of change in 12 months. And you heard from Scott a ton of new data sources coming online, not just new data sources, but also new vendors. Today, I'm going to talk a little bit about how those underwriting systems have evolved, what insurers are looking for, and how you can pull it all together to actually support the future of underwriting. So really, the future of underwriting is here now, and underwriting technology is scrambling to catch up. It's been re-architected to support these new data sources, and most of which are fluidless. Scott mentioned that there's tons of new fluidless evidences accelerating, but also more complex decisioning. Really, we're seeing that on the technology side as well. Demands from our customers to take really complex decisions and really granular information, merge them together to come up with a decision as complex as a human underwriter could make in an automated fashion. The other point I wanted to make is the client experience in today's market starts with new business and underwriting. Historically, we've seen underwriting as a back office or middle office function. The client really is not engaged with it, but because we're now pushing that right to the front end, tons of point of sale solutions, the client expectations are sky high. It's not just quick, but also less intuitive process. But also, you want to make sure that the technology that's underlying this brings that customer intimacy that Peter spoke so clearly about. And then, of course, significancy of accuracy in the data captured in the interviews, super important. Convergence of the behavioral science. We're starting to see behavioral science really impact technology in this area. Before, it was questions that were filed and used over several years and no one really looked at it. Now we have behavioral scientists working on questions to craft them to make sure that you're gathering information intuitively, correctly, so you can make correct, great decisions. And of course, real-time ability to reflect inconsistency in the data is something that's very important and that's growing from a point of sale. So really, what's required to increase profitable sales in this new digital age? We think there's three pillars. Obviously, traditionally underwriting and actuarial expertise, super critical to it. But more and more, the center pillar of it, the thing that's holding it all up, are really data assets and models. Scott spoke a lot about this. These are predictive models, really sometimes even artificial intelligence, that are being integrated into the underwriting process. But tying it all together is really automated underwriting decision software. So we'll take a little bit look at the evolution of that in a few moments. But clearly, what our consumer or insurers that we deal with are looking at are, they really need to meet the consumer expectation. Everybody wants a less intrusive new business and underwriting process. Only ask the bare minimum of questions necessary to get the decision. Point of sale decision wherever possible. You don't want to allow people to change their mind when they're buying at the point of sale, to say, well, we have to do a little bit more research to come back, because then we know that consumer behavior drops way off. But importantly, you also want to maintain underwriting discipline and consistent application of underwriting philosophy. So how do we get all of those points through in an end-to-end process? So let's take a look at what insurers are really looking for when they're looking at underwriting technology, specifically underwriting engines. I think the clear message is everybody wants to move the insurance sale right to the point of sale as much as possible. They also want technology that's scalable. We work with companies all over the world that have, graveyards of legacy systems that are very difficult to scale, very difficult to integrate. So there's a lot of new technology that's out there that's SaaS-based, that can lift these systems out of legacy applications, put it on the cloud, make sure that it's always up to date, and it can be infinitely scalable. The other part of it is the technology that allows insurers to quickly increase channels. This gets back to what Peter Rhodes, his quote was about the omni-channel approach. We're saying everybody wants the omni-channel approach. Clients should approach the insurer the way that they feel most comfortable and switch channels seamlessly. So technology has got to support that. Obviously, improving the customer experience. No one wants an ugly looking website. No one wants badly designed questions. So the technology needs to support that. That's what insurers are really looking for. But of course, on the flip side of that is you can't go too far out, because you really want to maintain stability of underwriting decisions. Because you're in a long tail business. When you sell life insurance, it's a long tail business. You want to make sure that you're upholding your risk profile and your underwriting decisions. You want to aggregate data to better understand risk selection. I think that's super important as well. There's more and more data being thrown into the mix. And if you don't understand it, you could write a lot of bad business on the books using this technology before you realize it. And of course, the other part of it is reducing underwriting costs. And I think, pick up a little bit of what Scott said. The ability to mix and match evidences right to the granular level is something that a big demand being placed upon a lot of technology now. It used to be very monolithic, right? So if a policy came in, you ordered this panel of evidences. Now, insurers are being much more sophisticated, much more targeted to say, I want this evidence under this scenario, and these three evidences on another scenario. So I think technology really needs to support that, and it has been. There's been a sea change on over this. So let's talk a little bit about the evolution of underwriting rules engines. Before I do that, though, I did mention that change management. We all talk about it, but this is absolutely critical, in my view, to adoption of any automation. The underwriter's role will change in this process. And automated underwriting requires more than just rules engine. So there's a whole big infrastructure around that. Getting back to my point about the three pillars, right? Underwriting and actuarial analysis, data models, as well as the technology. So change management is really kind of underpinning all of these things when you relate to the selection of an underwriting rules engine. So let's talk about how they've evolved over time. When I first came into this role, I've been with RGA for about 15 years. We were really looking at the first generation rules engine, which are really tree-based rules engines. And I'm sure you're all familiar with those. Many of you who work for companies that are using those. These are rock solid solutions, but they're tree or tabular based, tightly coupled rules and decisions, extremely difficult to integrate external data into that structure. Very rigid. If you needed to deploy to another channel, you had to literally recreate your rule set for another channel. So that was our original and the first generation of it. The next generation, you started to see business rule management systems. So these are systems that combine rule syntax. You're starting to get more complex rules, introduction of rich comorbid and multivariate. So the ability to take data from different evidence sources and combine them together, sort of rudimentary. And also, and very importantly, decoupled architecture. And what I mean by that is the separation of questions and answers from rules, which is critical when you're injecting external data, and also when you're making very complex multivariate decisions. So we started to see that as well. Where we are now, I think, is in the third evolution of these rules engine. We're in what we call decision management systems. These are model-driven systems that use decision logic that combine both rules and predictive models. Generally, it's the output of predictive models that are combined with evidence sources as well as reflexive questions to have a very complex decision that then can be delivered to the point of sale. We're starting to see much more advanced multivariate leveraging across combinations of rules and predictive models. We work with some clients that are very complex predictive models that are combining with the applicant's disclosures, as well as very complex data coming in, prescription drug history in particular. So these systems need to support what the insurers are really pushing the boundaries. They're taking all this data in, they're combining it together, and they want a point of sale decision. So that's what's driving this evolution of these rules. And so that's where I think where we are now. Where we see in the future is really what I would call a future decision platforms. And these are still a little bit out there, but it's where you take artificial intelligence, cognitive computing, machine learning, combining that all together, and potentially big data sources to enrich the decision logic. So we see that as an enabler. We see the core underwriting philosophy still being encoded within the rules to support the underwriting risk appetite of the insurers, but also for regulatory reasons, of course, augmented by artificial intelligence and cognitive computing and machine learning. So for instance, you may have a decision that comes out of your rules engine, which is an algorithmic rules engine that says it's an accept decision with 50 debits. And then you run it through your AI engine that says, well, there's an 80% chance that if you might be able to accept this at a standard rating if these scenarios are correct. And then you present that to the underwriter to make a decision based on that. And that's what we're starting to see, what some of our clients are sketching out for the future. So we see that we're right here in level 3, moving very quickly to level 4. So it's an exciting time to be actually in insurance technology, and I'm very happy to be here. So let's wrap it up. Let's talk a little bit about what the future of underwriting and technology. Clearly, underwriting is a key strategic driver in business enabler. I mean, everybody that I talk to in the insurance world says that it's the core of what insurance companies really do. It really is underwrite risk selection. But there are significant shifts underway. As I mentioned, mindset and direction are required to make that leap. So if you're stuck with an older rules engine and you really want to leap to that next one, it's going to be difficult for you to make that leap, not only from a technology point of view, but as Scott pointed out, from a mindset and direction point of view, because there's so many options out there on the table. I also think that the roles of e-underwriting, data analytics, and dynamic underwriting are being targeted by disruptive innovation. We see that as being part of RGAX. All kinds of fintech and insurtech companies that are trying to disrupt this space with all kinds of innovative and cool ideas, and it's all coming at the people at the insurance companies all at once, and they're asking us as technology providers, how can you support this? So it's a very exciting time to be part of that. But I do think, though, that we got to get back to what Peter mentioned at the beginning, right? Which is a more intimate customer experience. You need to combine simplicity, efficiency, and personalization. Yet, do not forget about the risk profile of your business. So it sounds like a tough problem to solve, but insurance companies that I've worked with have some very dynamic people, and there's really a merger now between underwriting and data analysts and behavioral scientists. That 3 groups coming together to work on solving these complex underwriting problems. And lastly, companies with well-established underwriting platforms are just going to be better placed in the industry. You can work with partners to add new tools. So if you have modern technology that's modular, that's scalable, that can be easily integrated, when companies come to you with various ideas about how you can actually improve your risk selection, improve the customer experience, you can work with them because you can easily add those tools. You can exploit analytics from an expanded data collection. So once you have all that data, what are you going to do with it? You know, once you have to have it in a structured format so that you can then do some analysis on it and put it back in a good feedback loop. And that gets back to the point that Scott made, is that we are in danger in the industry of going into really a heterogeneous environment where everybody curates their own data. So I would agree with Scott that there needs to be some sort of industry standards, and there are, of course, but I think, you know, we are slightly in danger of that at the moment. And of course, we need to evolve to decision modeling-based processing over the coming decade. I mean, risk management and selection, it's about to get a whole lot more interesting, which is, you know, something I don't think I'd ever would have said when I first joined about 15 years ago. So thank you very much, and I'll turn it back over to Nic for some questions.
Thank you, Paul, and thank you also to Scott and Peter. It's certainly the complexity is quite astounding, but I think also the opportunities that the technology, but also the shift in consumer behaviours is offering to the insurance industry. We wanted to really just spend a few minutes now exploring a number of these concepts in a little bit more detail. And one of the things that perhaps we could start off with, we talked to Peter at the start about some of these sources of new data and evidence and how it's really supporting the transformation. What are you seeing as some of these new data types that are emerging in the industry?
That's a great question, Nic, and one that I'm proud to say is a fairly lengthy list at this point. Categorically speaking, we're seeing a range of vendors coming into the electronic medical record space. The composition, the footprint associated with each is slightly different. They're not all made the same. So selecting the right vendor in the space has been a real interesting opportunity. In addition, we're also seeing a range of vendors in the medical claims space, which gives us a real good view into what that consumer's experience has been. It's not a tool that is right for each and every segment of the marketplace. Depending on the socio-demographics or the nature of your product, you might not have an audience that is naturally covered by health insurance, but this is a great tool that's available real time. There's a degree of complexity associated with this, just like EMR, but it's very knowable. It's very assimilatable to our business processes. And you also have the benefit of clinical lab data being brought to us by folks like Exam1 with their lab picture product. In addition to that, I would say you've got a range of fairly traditional vendors who are able to kind of step into the next generation by bringing in new data capabilities and new partnerships under their umbrella. And I think here, again, a Lab1 as an example, being able to synthesize traditional evidence as well as RX, medical claims data as well, but also players like MIB, who's been around in excess of 100 years, who have been able to build out a nice portfolio of tools and capabilities there.
Yes, Scott, I just want to build on something that you laid out when you talked about this transition from homogeneous collection. Back to that concept of the embedded insurance. All those people who are providing embedded insurance, one of the key ingredients is they're bringing their own proprietary data into the mix, which may or may not be used for underwriting. It's really that data that's going to be then used to either translate into a different type of product, a product offer, or underwriting, or even continuous underwriting. So I think we're really at that point where you're going to see that to go, I really like your analogy from something homogeneous to much more heterogeneous. There's going to be a lot of experimentation out there, and we're seeing that through this embedded insurance concept.
That's a great point, Peter. And from my perspective, that is the value associated with tailored solutions. You may not be needing to use that affinity partner's data to effectively underwrite risk, but you know something about this audience. And the industry's got a lot of experience in understanding bank channel, in understanding executive benefits. And we bring to bear aggregate norms in terms of pulling together both product and process, standing behind that market. So this could be a direction that we go in those kinds of tailored solutions.
Paul, just kind of picking up on that, new sources of data and really exploiting the opportunities offered by the data. How are insurers' decisions, I guess, when they're looking at systems that can support their processing aspirations, really impacted by their data appetite?
They're greatly impacted by their lack of data in many cases. Most insurance companies that I've dealt with over the last several years, they have a great desire for understanding what's going on in their underwriting and new business process, but they moved from paper applications to fillable PDFs, which is really just images of paper, right? So they now have a much better process, maybe even a nice front end that collects that data, but they still haven't liberated that data and actually made it searchable and actionable. And I think that's what they're really looking for, is they're really looking for a way to digitize all of that data, all that underwriting data, so that they can then combine it with their actuarial data, their claims data, certainly, to build models. And that there's a big demand for that. And that the ability to merge all that data together is a great demand on the technology side, for sure.
Peter, you had some interesting insights just in terms of the next generation of consumer. Can you expand on some of the expectations that you see are emerging from the digital consumer?
Sure. One that I think is that transcends across all three of us in our topics. This new consumer, they expect to get really almost an apply and buy sort of situation. They don't expect to have physical documents and certainly not a blood draw or some of these sorts of things. It should be seamless. It should be able to be done completely online. They expect the products to be very much relevant. The time where you come out of left field and say, how about this as a cross-sell and upsell, are kind of long gone. You got to take cues from how we've interacted online and give me something personal and relevant. It's really about ongoing value exchange is what it comes down to. And then the last thing, I think, when the time comes for these products to be consumed, claims to be paid, they expect it, again, to be done digitally online. I shouldn't have to look for a physical check or some other things that can be done. So I think that's what we're going to see, the complete digitization. I think we made great strides on some of the distribution part of the ledger so far, but I think they expect it across the entire value chain.
Yeah, absolutely. Scott, one of the curious things that we seem to be seeing at the moment is just the sheer number of new entrants into the vendor space, not just in terms of providing solutions, but evidence. I can't recall another time where we have seen so many new evidence providers emerge. What do you see as the difficulties really in evaluating and selecting not just new evidence types that are being offered up, but some of the vendor partners?
Yeah, it's an interesting phenomenon. For those of us that have been kicking around a little while, in my personal circumstance, I waited 20 years for the first new vendor to come up. And now all of a sudden we're awash with opportunity, which is just phenomenal. But think of the complexity of sitting in a chief underwriting role or chief product actuarial role and having this veritable fire hose pointed at you. And you have this fear of missing out. Am I missing the item that is going to help me recover protective value as I step away from traditional evidence on an acceleration program or a light touch strategy? Who do I select? Both categorically speaking, what's a good fit for my applicant pool? But to your point, a lot of these folks are fairly new, even though they might be data products that are brought to us by traditional players in the market, like a partner like MIB. There are just so many new data providers with relatively short pedigree, which is a plus and a minus. In that paradigm, they oftentimes have very, very capable technology that is extensible not only to your native systems, but also to the capabilities that you're curating on the front end. But importantly, they've got very, very capable reporting and analytics aspects of that. So it's a wonderful little confluence of pluses and minuses, but one that creates a degree of difficulty. Once you have a vendor in hand, that's where the fun and challenging part comes, right? In being able to understand what is in their data payload. Is it relevant to your product and applicant pool? Do you understand what the hit rates may be? Do they vary across different segments of your product portfolio or your applicant pool? And importantly, do you understand the protective value in each of those subordinate segments? Is it performing the way that you expect? We have to build those credibility models, and we've got to do that on the quick to make sure that we're keeping pace with the market. And importantly, underscore the need to resource that vigilance piece, watching these things perform in market to see how changes ebb and flow over time.
Thanks, Scott. And I guess, Peter, sort of in a similar vein, sort of when we look at new data and evidence types, clearly sometimes distribution offers or distribution opportunities can be built around some of those new data sources and evidence types. Yeah, have you seen sort of any interesting examples in that area?
Yeah, what I'm going to do, Nick, is take your question and kind of point it at the back half of what Scott was talking about, which is, you know, the continuous underwriting or the continued relationship. As a consumer engagement person, what I'm intrigued about and the opportunity I see is, can we get into the prevent and predict on the claim side of things? So that's where a lot of this consumer engagement, the ongoing relationship is. If as I showed you earlier, a lot of the millennials are downloading carrier apps. We know all these fitness tracking and other vehicles are available. So, you know, there's not only evidence that's being used for decision making at point of sale, but it's really about information that's being collected ongoing. I don't really think that use case has been fully developed, but that's where trust comes to play. I now believe that there's a trade-off, and I think that's a great frontier that we're going to see moving into prevent and predict on the claim side. So another way to kind of leverage profitability. I don't know, Scott, if you want to pick up on that at all.
Yeah, thank you, Peter. I think you're broaching a very important topic here. A lot of these data products aren't pointed yet at a very specific segment of the value chain. They show a lot of potential, either as an engagement tool on the front end, an engagement tool to keep that steady relationship going with the purchasing customer, but we don't know what it means yet, right? It shows potential. Certainly somebody that is doing their 10,000 steps and sleeping well and taking good care of them should logically get the benefit associated with that. But how does that persist over the long haul? How does that translate to tools and capabilities that we could use to enrich a product, keep that engagement going up in a continuous fashion? So it's an exciting time to be sure, but there are also a lot of perhaps false starts and sometimes even some dead ends, because these vendors are coming to us and hoping that we can shape how their data products are used, which has created a new relationship with those folks, as opposed to having them arrive with fully baked solutions, knowing exactly how they snap in.
We have just a few minutes left, but I really couldn't see us close out without picking up on something that Paul had mentioned about insurers being hampered by legacy systems in some instances. I guess there is a fear in the industry about potential new entrants and disruptors, and some of the established players perhaps being handicapped by legacy systems. Well, I mean, did you have some thoughts or insights into how that can be perhaps successfully addressed?
Yeah, sure, Nick. There is a lot of fear in the larger insurance companies, especially ones that have been around for a long time or that have merged with many other companies that have tons of different legacy systems that are really kind of wired together. What if these new entrants that have none of that legacy burden? Now, of course, they're still new entrants and they still have to make a brand for themselves, name for themselves. So we are seeing lots of these legacy clients reinventing themselves, creating new subsidiaries. Certainly on the technology side, our RGA and RGAX has been involved in that with some of these ventures as well. So I think the larger legacy insurers are really they're rising to the challenge of these new entrants and they're creating their own digital insurers, direct-to-consumer insurers, partnerships with others. You see that all over the world actually. So I think that's really how the most of these larger legacy insurers are really fighting back.
And on that note, we might wrap it there, but clearly there are a lot of interesting and quite detailed topics that we'd be only too happy to talk more about and to take any questions that you might have. So thank you again to Peter, Scott and Paul for presenting today, and thank you to Josh Landauer of the IAS. If you'd like to learn more about RGA or the topic that we presented on today, please don't hesitate to reach out to me. We'll also have a short survey that will be available at the end of today's session. And we kindly ask that you complete it by scanning the QR code with your camera on your smart device. Your feedback is very important to us, and we do use it to help develop and prioritize the content we focus on in future presentations. Finally, a recording of the session will be available on the IAS website for your interest. Thank you everyone for joining, and good health.